As we make our way into the fall season, there are many questions as to how the course for monetary policy might influence rates and fixed income markets. How should investors consider positioning within fixed income? A conversation well worth your 10 minutes right here on UBS Trending. Hi, everyone. Welcome to UBS Trending. I'm your guest host, Dan Cassidy. Joining me here at the table, glad to welcome back Leslie Falconio, the head of taxable fixed income strategy for the Americas with the UBS Chief Investment Office, joining us today to break down the latest fixed income strategist publication. Leslie, great to be back with you here at the table. Thank you for spending some time with our viewers and looking forward to hearing your thinking on fixed income markets.
Thank you for having me.
So, Leslie, a lot has taken place since we last spoke. You think about, in particular, I have to acknowledge U.S. Treasury yields, which have pushed higher over the past month. What's the catalyst behind that? And you think also about the Jackson Hole Symposium, the recent JOLTS print, which did demonstrate a decline. Any reaction to those events?
Yeah, I mean, obviously, the 10-year Treasury yield over the past month has taken a fairly strong leap forward. Particularly on stronger growth expectations, the economic data coming in much stronger than expected. You know, obviously, there's certain catalysts that we've talked about that have been really that tailwind to rising rates, such as supply, the third quarter GDP likely to be fairly strong. You know, so all of these sort of variables have pushed 10-year yields a bit higher. And as a matter of fact, you know, we had gone to about a 436 intraday, which is really the high, which is actually higher than it was in 2022. But when we think about, some of the drivers of this and what's happened since Jackson Hole, testimony to your point, Dan, is that, if Powell actually stated what the market was expecting in terms of, not there was any new information, but he just said it in a more hawkish tone. And when we think about how much we've reversed in yield since that time, to your point, just look at something like the JOLTS data, which actually has, the quit rate declining, job openings going down. That's pushed 10-year yields, a little bit lower back to that 408 range from that 436 that we've seen. And, as you know, Dan, our expectation is that 10-year yields to the end of the year trend lower, in 2024 start to trend lower. But most importantly, when you think about one of the shifts in sentiment that has really been very important in our opinion is the amount of easing that the market has priced out in 2024. So when we think about going back to May, like the market was saying, okay, Fed, you're probably going to ease about 160 basis points in 2024. That's down to about 105. So it's really taken out a lot of this easing, really accepted that higher for longer, and that also put pressure on interest rates as well. But as a benefit to that, fixed income asset classes are yielding, much more than we've seen in the past 10 years, which really is a tailwind to total return.
And I do want to get to performance a bit later, but with Jackson Hole, no surprise with the substance, more so with the delivery, is what it sounds like.
That's absolutely right. I mean, you always want to, pay attention to that substance, but he didn't say anything that was overly surprising, but his tone was a bit hawkish.
So with risk assets in particular, they've had a very strong 2024, lower credit quality. What would you say are the drivers for this, Leslie? And do you feel that serves as a tailwind for a soft landing in the months ahead?
Well, listen, there's no question when we think about the credit, particularly lower credit quality credit, how well that sector has done. I mean, you look at high yield, that could be up 8% this year. The CCC sector within that high yield universe is up about 13%. So that's done, exceptionally well. We know some of the reasons for that. Some of them are because, as we've discussed many times right here, is that, a lot of these companies had the ability to term their debt out at much lower interest rates, back a few years ago. There's been lower supply, which has been a great technical tailwind. But also, as well, we know that these companies aren't as levered as they once were back when you think of the great financial crisis. Also, too, given the fact that the yield curve is inverted and you have this sort of alternative cash, right, this money market funds, which we know are yielding a tremendous amount, a lot of investors are looking and saying, okay, the economy is really, these past, 7-8 months has been much stronger than what I expected, so therefore they're much comfortable going into lower credit quality. And where you're seeing this as well is that if you look at the yield for a lot of this lower credit quality, even the higher credit quality is IG, but things like high yield, as interest rates have gone up, their yields have actually stayed the same the past, say, several months because spreads have compressed. Now, Dan, as you know, we do prefer that higher quality, and one of the things that we've noted before, particularly on this show, is that even after the Fed pauses, defaults have a tendency to go higher.
Sure.
And we know there's a lagged effect in terms of the impact of the economy and what the Fed has done, and we're expecting the economy to slow. We're really expecting to see that lagged effect also coming into 2024. So in our view, in our allocation, which I know we'll discuss a little bit later, it's really not about going into that lower quality credit because you're getting very good carry and higher quality.
So with that, Leslie, let's spend a few moments talking about positioning. I do want to bring up that you recently recommended going long real yields. So I'm curious as to what drove that decision for a most preferred position, and how does that strategy reflect your current fixed income positioning?
Yeah, well, recently real yields have gotten to a level that we haven't seen in almost 15 years. For example, if I look at a 5-year real yield, that's say about a 220, 225, we haven't seen that in over a decade. Even the 10-year real yield that's been averaging, say, between 175 and almost at 2% a little bit, those are very high, right? And across actually what we call the TIPS curve, Treasury Inflation Protection Curve, which are the real yields, they're positive across the curve. And again, we haven't seen this in a while. So our view was, given the fact that we've had nominal rates rising to levels that actually broke the 2022 high, combined with the fact that we have seen break-even inflation expectations, come down a bit as that year-over-year inflation starts to trend lower, it was a really great time to get into these tips or like real yields. Our preference has been for the 5-year area for 2 reasons. One, if you can have the purchasing power of a 2.2%, real yield, which again, that's the key. What's your purchasing power? It's going to be the yield that you're earning minus your inflation. Right? And the fact that you have this at a 2.2 is incredibly attractive. And given the fact that we do think the economy will slow and the Fed will pause, maybe they go one more time in the fall, but they're close to pausing, that 5-year will really benefit as part of the yield curve. So that's why we went into the 5-year tips, and that's why we like the real yield.
Well, the September Fed meeting coming up in just a few weeks' time from when we're speaking will be an interesting takeaway and will be a key test. So I'm sure we'll cover that next time we speak.
Absolutely, no question.
Well, Leslie, as always, thank you for joining me here at the table, sharing with our viewers your thinking and, of course, the guidance when it comes to positioning within fixed income. Always appreciate it, Leslie.
Thanks, Dan.
For more information, visit ubs.com/views. Make sure to follow UBS on social media, including LinkedIn, Facebook, Instagram, and Twitter. And check out our Instagram channel at UBS Trending for UBS Studios content that you can't find anywhere else. And as always, if you have any questions about your portfolio, please speak with a financial advisor. Until next time, I'm Dan Cassidy filling in for Anthony Pastore. Have a great day, and remember to keep your eyes on what's trending.